this sell-off already over? That's the question that we're no doubt asking ourselves today when the market finds a little bit of relief after what was a very ugly day yesterday. And not surprisingly, the sort of natural inclination to buy the dip that's been the story for the markets for so long is understandably back at the front burner. We're going to dig into this and see if this is just another one of those, or if there's something more that's maybe starting to brew here. As ever, of course, this is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live, and we'll start with a look at the price action, what we saw over the past day here, and see if we can't make sense of that and go from there. Looking at the way that things performed here, we can see a slight upswing for the S&P and NASDAQ after yesterday's brutality. About 0.4% for the S&P, 0.6 for the NASDAQ. Not too chipper, but nevertheless a big swing. And intraday, the swing was ultimately more impressive than these numbers would imply. Because at one point, of course, the sell-off, let's say in the S&P, looked like another big decline. Overnight, futures were off almost 0.8% in the S&P, and that's after a big 1.2% sell-off yesterday, which was itself the worst since that big shock lower on October 15th, where the market fell, S&P fell 2.7%. So yes, we're only up a little bit today, about 0.4%, but the actual intraday swing from the low to the high was a much more convincing 1.6%. So it was indeed a vigorous buying of the dip, at least for U.S. markets here. And it seemed to line up nicely with the economic data, which we'll dig into momentarily. We do finally have a little bit by way of economic data, and it's not government data, but did give us a little bit of a run across markets today. We'll take a look at what that was momentarily. Of course, that same story around this surge in yields, they continue to march higher. 10-year up almost 2%, 2-year up 1.7%. Interestingly, gold bounces despite the fact that we have higher yields, and despite the fact that the dollar is at best a mixed bag. The euro not really managing to rally, but stopping to fall, up 0.1%. The yen, though, definitely on the chopping block as yields rise. That's typically what happens. Yen is a very yields in the U.S. sensitive kind of an animal. It's down 0.3%. Bitcoin, everything's orderly there. It's basically mirroring stocks. Stocks went up, so Bitcoin went up more. Typical sort of risk on high beta behavior, up almost 3%. Crude oil back to doing its own thing, down 1.5%, scratching at the bottom of its recent range. But really the story here, crude oil aside, and perhaps gold aside as well, because its upswing kept it within its consolidation range where it has remained for quite a long time. I mean, it's basically been anchoring going back to before the Fed. Kind of fell into this range right under the 4,000 figure on the eve of the Fed meeting last week, and has been generally oscillating around that level, around 3,900 on the downside and maybe 4,100 on the top side of the range, maybe even a little bit narrower, something like 4,070-ish, 4,060. So gold, yes, there is an upswing, but yesterday we had a downswing of 1.8%. So this is just range-bound behavior. But those things aside, the big story was the dollar, Bitcoin, NASDAQ, S&P yields. And that largely came from this data here. This is the ISM service sector report. Of course, we got the manufacturing numbers earlier in the week. They were a little bit soggy. As ever, this is done in the logic of PMI data. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So when we got 48.7 on the manufacturing number earlier in the week on Monday, that was a faster contraction than the expected one at 49.5. So the manufacturing sector shrank and shrank faster than anticipated. That was not the story for the service sector today. And that was, of course, much of why we ended up seeing the price action that we did. We can see 52.4 is a much stronger pace of growth, much faster expansion than 50.8, which was the expectation. That's after 50 on the nose in September, which basically put the service sector at standstill. If we consider here what this generally means, and consider, let's say, that the spread between the service sector and the manufacturing sector is something like, let's say we ignore agriculture. It's more like 70% services, 20% manufacturing, 10% ag. But let's just forget about ag for a second and keep things simple. So if we're looking at a 70-30 spread, where most of the economy is services and a smaller share, a 30% share in this sense, is manufacturing. So if we consider that and kind of do the math on where we are, seemingly, it's something on the order of 51-ish, give or take. 51.2, maybe 51.3, something like this. So the overall economy seems to be growing. The pace at which it is growing seems to be relatively modest, but it seems to have increased from the prior month. And what we're looking at seems to be then, at least in part, the logic that the Fed was invoking when it was saying last week, hey, we seem to be looking at economic activity that's accelerating, even as the labor market is weakening. So we're cutting to backstop the labor market, but we're not going to jump in front of the inflation story in an accelerating economy. So this December cut that you all seem to think is for sure, it's not that. It's not a foregone conclusion. Looking at the details of the report here, we can see the price component in particular, and this, of course, would be why the Fed wouldn't cut rates necessarily. It's back to its highs here, so inflation's still running very hot, multi-year highs, as we can see here, in the service sector. We did get a welcome pickup in new orders, but employment continues to shrink, sub 50 here, albeit at a slowing rate. So obviously, this number further out below 50 speaks to faster contraction in employment than these numbers here. So for the past several months, we've lost jobs, but at a slowing rate. Now, if we take a look at both of these surveys now and just look at the Fed story, we can kind of get exactly what the Fed is looking at. Employment in both the service sector and the manufacturing sector is contracting. It's doing that at a diminishing pace for both over the past, let's call it 3 months, but nevertheless, there it is. And we've seen this deterioration first in the pace of hiring, then with the shift toward contraction, we've seen the trend here continue now for really a few years. But from the Fed's perspective, the issue is that when you then look at inflation, you saw inflation radically slowing over the front part of this. So while this employment situation was getting slowly cooler, inflation was getting a lot cooler in a hurry. Again, this is the service sector and the manufacturing sector. You can see, at least for the manufacturing side, inflation has been cooling off a little bit after some peaks earlier in the year, but the trend certainly still not a friendly one. And for the service sector, which is a much bigger part of the economy, the trend hasn't even turned. So this is really the Fed's conundrum. Inflation is elevated, employment is shrinking. And so this is how you end up with what you see now in Fed policy expectations as the highest possibility that we're not going to get this rate cut in a few days. So we're about 60-40 now, a little bit over 60% chance that we are still going to get this cut, and a little bit under 40% chance that we stand still. But as you can see over the past several days here, I mean, this is yesterday, this is a week ago, and this is a month ago. Now, of course, this already, because a week ago looks back to Fed Day, this already gives you this big adjustment. But the day before this, and you can kind of see the reference point a month ago, well over 80 and approaching 90, the day before the Fed, this was in the high 90s. And we've swung now to the low 60s. So the adjustment has been huge. And what the markets clearly seem to be attempting to make sense of here is how much this is an issue. And of course, what we learned in the wake of the response to what the Fed did, and in particular to what Chair Powell said about this, is that this is quite a significant issue. Because this, what we saw today, is the first meaningful uptick for risk since that Fed policy announcement. So to put this in context, it was not the world's biggest rally. Again, ultimately, I think we end up with settling around a 0.35% rise. That's still the smallest rise that we've seen since October 27th. That was the gap that we had at the start of last week when we learned that the situation with U.S. President Donald Trump and Chinese President Xi Jinping was probably going to be okay. That was when the Treasury Secretary, Scott Bessent, came out and said, hey, we had some meetings over the weekend. These guys just have to rubber stamp agreements we've already made. Everything's going to be fine. That, of course, was a meaningful gap. Before that gap, the last kind of big move was the Friday before, October the 24th. That was a gain of almost 0.8%. But the move today, pretty soggy by comparison, and sellers really coming out in force into the close, such that what we end up with, very interestingly here, ultimately on the day, is something of a letdown, perhaps. We've erased maybe about 40% of the intraday rally just in sort of the 2 hours, give or take, the last 2 hours of the day. So it would seem as though the markets are still unhappy with this Fed adjustment. And looking at the policy expectations here, we can see we continued to narrow in now the remainder of this year and next, adding up to 65 basis points, of which most clearly are centered on next year. Now, it's certainly the case that the Fed is still less dovish than even that. The markets are out by a fair amount here. The Fed has only baked in a 25 basis point cut for all of next year, whereas the markets are still at least 50 and about 50-50 chance on a third cut. So we're 13 basis points into a third cut here. But it does look like there is some degree of indigestion, because as we get this adjustment, as we get this pullback in dovish expectations, yes, the S&P bounces today, but the overall trajectory here is clearly some degree of the brakes being applied on this rally. Meanwhile, if we look at the US dollar, it's a little bit less vigorous today, but the change in expectations clearly helping it move along. And we can see that actually it has started to rally since these rate cuts began. Here's the September move. Here's the October move. Ostensibly because it had already fallen enough to price all of that in. And so once speculation becomes reality, it's time to go the other way. And so the dollar here is heading higher. The last sort of bit of data that we know is happening this week, we were supposed to, of course, get a jobs report this week, but with this shutdown now the longest on record by a day, doesn't look like we're going to get it. Instead, we're going to get U.S. consumer confidence data. And here, things are interesting in that really going all the way back 4 years, the start of kind of the post-COVID inflation kerfuffle. The story has been when consumer inflation expectations in this University of Michigan data rise, overall sentiment declines. So consumers are primarily worried about inflation. Not surprising. So here we go. Here's the start of 2021. Inflation expectations are rising. Sentiment is cooling. Going into early 2022, the Fed gets religion on this. Of course, by June of 2021, they're already saying, listen, we're gearing up for a rate hike cycle here. Buckle up. By the beginning of 2022, in March, they start that cycle. Inflation expectations peak. As they start to come off, sentiment improves. This continues all the way until the beginning of this year, where the tariffs obviously give us a big spook in inflation expectations. Sentiment duly weakens. It starts to come back as inflation expectations cool. This is the peak around April and Liberation Day. And of course, since then, the administration has softened its stance by a good bit. We still have tariffs, but they're not as bad as the foam board would have had us think. But what we see now is for the past 3 months, inflation expectations have been easing, but sentiment is easing and getting soggier anyway. And so perhaps the narrative is changing here and the consumer is getting more defensive, and cooling inflation expectations are just not enough to get them happy. Perhaps they're cooling for the wrong reason, at least in the minds of investors. So this will be an interesting thing to watch at the end of the week because, of course, it'll be a referendum on consumption. Consumption is by far the biggest component of GDP, 68-ish% of the total. And so once we kind of take away all of the many things making this year's GDP numbers fuzzy, be it wildly swinging inventories and import numbers around the tariffs, first the front running of the tariffs, then the passing on of tariff costs to consumers by wholesalers, taking all of those gyrations out of the way because, of course, they're headline grabbing, but they're not the biggest influence on overall GDP, not by a long shot. It's consumption. If consumers are getting defensive here, then there's a larger story. And in fact, tighter Fed policy is a bigger sort of concern than meets the eye, not just for the markets from a speculative perspective, but for the economy. Perhaps the Fed is wrong about this reacceleration. Certainly, though, the economic data that we've seen come out in recent weeks, though, looking at this university or this Atlanta Fed GDP expectation here, it's mostly favored the top side. We can see, of course, not only is the nowcast basket moving in a generally sort of positive direction, where we can see the data that's coming in that's feeding this model seems to be GDP positive, in that what data flow we have, we are getting a push higher from it. The interesting thing is that's already spilling over even into the consensus view, such that the estimate here of what sort of the analysts' baseline for the third quarter look like, that's been pointing higher. And so all of this sort of taken together seems to be suggesting that what we're looking at is at least economic data that's biased towards surprising higher. It kind of implies that whatever analysts have in their forecasting is probably more pessimistic than it ought to be. Because at least at this point, we've had this justify a revision in the expectations, and clearly whatever is coming out is still meaningfully higher than that. And so there's some kind of wedge here, despite the absence of economic data that suggests things are upbeat. So if sentiment holds up, the real big question will be, well, is that in fact good news? Because if it holds up, then there's less scope for rate cuts, and then this issue continues. Now, if anything, what we saw today was an arresting of the sell-off after a big down day yesterday. In fact, the worst since that horrible day on October the 15th. Is this the place where sentiment is going to turn? Well, maybe, but I don't think what we have here is confirmation that the underlying logic of the sell-off, that is, that the markets went into last week priced for perfection, expecting the Fed to be non-controversial, expecting the Trump-Xi meeting to be non-controversial, expecting the earnings front to be non-controversial. They got the Trump-Xi event risk right. They got the earnings right for the most part. Meta was obviously a big miss, but other than that, things were generally good. And of course, looking at the way that earnings have performed more generally, it's about a 10.7 earnings growth rate, 10.7%, according to the latest numbers from FactSet. And of course, everybody's favorite sector, the tech sector, is outperforming that and is the best performing of all the sectors. No big shock there. Earnings growth for that space, 26.5% in the third quarter. So that seems to have passed without too bad of an outcome, despite some sogginess here or there. But the Fed clearly did not deliver as the markets wanted. And since it has not, things have been soggy. So I, for one, am not convinced that this is the dip to buy, at least not yet. Perhaps this is merely a correction on the way to a down move that's still developing. Markets don't move in straight lines after all. And so with that in mind, the exposure I have here, largely unchanged, still short a little bit of gold. That took a little bit of a knock today, but the range holds. And so for now, I remain. Same thing with the other way I have this exposure, which is through selling a call vertical. That's actually doing a little bit better than the outright futures because vol has eased a little. Still very long the US dollar, short the Aussie, pound, euro, and the Canadian dollar. That continues to work. Still short risk. And so a little bit short Bitcoin, a little bit short the S&P through IBIT and SPY put verticals. Probably the biggest pain point in the portfolio today was this surge in yields. I'm still long TLT, so buying the long end of the yield curve. It hasn't crossed any Rubicons yet, but it's getting a little bit hairy, and so I'm watching this closely. It's right around the levels where I got in, maybe a little bit higher, and so I'm looking at this closely to see if maybe I need to pull the plug or instead add to the position because it's going to bounce from these levels again, and short a little bit crude oil. Which is working a little bit more today than it has in the past several days via a put vertical. And we'll see how that develops. Maybe some legs more here on this move after the range break today. And that is macro money for today. As ever, we are here Monday through Thursday after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, usually looking at the Wall Street close and where things may go therefrom. I'm also writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on Blue Sky and on former Twitter. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.